we did in the same way. We mailed it from the House.
So are we going to get somebody to run the finance markup? Finance markup. Well, okay. Thank you. The committee is pleased to welcome Chairman Greenspan this morning to hear the Federal Reserve semi-annual report to Congress on our nation's economy. As many have noted on countless occasions, the Fed, I believe, has done a remarkable job under Chairman Greenspan's tenure. Our economic expansion is in its 8th year, making it the 3rd longest in the post-World War II period. I'm going to ask that the full text of my remarks be included in the record as if read in its entirety, because we really are here to hear the chairman. I'd also might note that a number of our colleagues are at a Finance Committee markup which is taking place, and at some point I'm going to have to leave to participate in that markup. And so I'd ask our colleagues, in respect to the chairman and to his time, and I'm talking about Chairman Greenspan in terms of his constraints, to see if we can't limit our remarks so we can hear from the chairman, and then pose whatever questions we would like to put to him. And with that, I'll recognize Senator Boxer.
Mr. I'm anxious to hear from the chairman. I'll pass it this time.
Senator Reid.
Mr. Chairman, I think we should proceed right to the chairman.
I thank my colleagues. Chairman Greenspan, I think this is the quickest you've ever gotten on. And before anyone else gets here, I'd like to hear your remarks.
I've been looking over the last, in my mind quickly, the last, I think, 20 times I've been here, and I guess you're unquestionably correct. There's nothing even close. Anyway, thank you very much, Mr. Chairman. I have a rather extended prepared text, and from which I will be excerpting significantly, and request that the full text be included in the record.
So ordered.
I very much appreciate this opportunity to present the Federal Reserve's mid-year report on monetary policy. Overall, the performance of the U.S. economy continues to be impressive. Over the first part of the year, we experienced further gains in output and employment, subdued prices, and moderate long-term interest rates. Important cross-currents, however, have been impacting the economy. With labor markets very tight and domestic final demand retaining considerable momentum, the risks of a pickup in inflation remain significant. But inventory investment, which was quite rapid late last year and early this year, appears to have slowed, perhaps appreciably. Moreover, the economic and financial troubles in Asian economies are now demonstrably restraining demands for U.S. goods and services, and those troubles could intensify and spread further. Weighing these forces, the Federal Open Market Committee chose to keep the stance of policy unchanged over the first half of 1998. However, should pressures on labor resources begin to show through more impressively in cost increases, policy action may need to counter any associated tendency for prices to accelerate before it undermines this extraordinary expansion. When I appeared before your committee in February, I noted that a key question for monetary policy was whether the consequences of the turmoil in Asia would be sufficient to check inflationary tendencies that might otherwise result from the strength of domestic spending and tightening labor markets. In the event, the contraction of output and incomes in a number of Asian economies has turned out to be more substantial than most had anticipated. Moreover, financial markets in Asia and in emerging market economies generally have remained unsettled, portending further difficult adjustments. The contraction in Asian economies, along with the rise in the foreign exchange value of the dollar over 1997, prompted a sharp deterioration in the U.S. balance of trade in the first quarter. Nonetheless, the American economy proved to be unexpectedly robust in that period. Evidently, optimism about jobs, incomes, and profits, high and rising wealth-to-income ratios, low financing costs, and falling prices for high-tech goods fed the appetites of households and businesses for consumer durables and capital equipment. In addition, inventory investment contributed significantly to growth in the first quarter. As evidence piled up that the economy continued to run hot during the winter, the Federal Reserve's concerns about inflationary pressures mounted. The robust expansion of demand tightened labor markets further, giving additional impetus to the upward trend in labor costs. Inflation was low, though given the lags with which monetary policy affects the economy and prices, we had to be mainly concerned not with the conditions at the moment, but with those likely to prevail many months ahead. Although national income and product data for the second quarter have not yet been published, growth of U.S. output appears to have slowed sharply. Indeed, readings on the elements that make up the real GDP have led many analysts to anticipate a decline in that measure in the second quarter after the first quarter surge. It is worth noting that other indicators of output, including worker hours and manufacturing production, show a somewhat steadier, though slowing pace over the first half of the year. And underlying trends in domestic final demand have remained strong, imparting impetus to the continuing economic expansion. Labor markets became increasingly taut during the first half, but at least through the first quarter, the effects of tight labor markets and a rising wage bill on production costs were moderated by strong gains in productivity. Indeed, inflation stayed remarkably damped during the first quarter. The Consumer Price Index, as well as broader measures of prices, indicate that inflation moved down further even as the economy strengthened. The most recent price data suggest that overall consumer price inflation moved up in the second quarter, but even so, the increase remained moderate. In any event, it would be a mistake for monetary policymakers to focus on any single index in engaging inflation pressures in the economy. Although much public attention is directed to the CPI, the Federal Reserve monitors a wide variety of aggregate price measures. Price pressures appear especially absent in some of the measures in the national income accounts, which are available through the first quarter. So far this year, Mr. Chairman, our economy has continued to enjoy a virtuous cycle. Evidence of accelerated productivity has been bolstering expectations of future corporate earnings, thereby fueling still further increases in equity values. And the improvements in productivity have been helping to reduce inflation. In the context of subdued price increases and generally supportive credit conditions, rising equity values have provided impetus to spending and, in turn, the expansion of output, employment, and productivity-enhancing capital investment. The essential precondition for the emergence and persistence of this virtuous cycle is arguably the decline in the rate of inflation to near price stability. In recent years, continued low product price inflation and expectations that it will persist have promoted stability in financial markets and fostered perceptions that the degree of risk in the financial outlook has been moving ever lower. These perceptions, in turn, have reduced the extra compensation that investors require for making loans to or taking ownership positions in private firms. With risks in the domestic economy judged to be low, credit and equity capital have been readily available for many businesses, fostering strong investment. And low mortgage interest rates have allowed many households to purchase homes and to refinance outstanding debt. To a considerable extent, investors seem to be expecting that low inflation and stronger productivity growth will allow the extraordinary growth of profits to be extended into the distant future. Indeed, expectations of earnings growth over the longer term have been undergoing continual upward revision by security analysts since early 1995. These rising expectations have in turn driven stock prices sharply higher and credit spreads lower, perhaps in both cases to levels that will be difficult to sustain unless the virtuous cycle continues. Probably only a few percent of the largely unrealized capital gains have been transformed into the purchase of goods and services in consumer markets. But that increment to spending, combined with the sharp increase in equipment investment, which has stemmed from the low cost of both equity and debt relative to expected profits on capital, has been instrumental in propelling the economy forward. The consequences for the American worker have been dramatic and, for the most part, highly favorable. A great many chronically underemployed people have been given the opportunity to work, and many others have been able to upgrade their skills. Government finances have been enhanced as well. In the federal sector, the taxes paid on huge realized capital gains and other incomes related to stock market advances, coupled with taxes on markedly higher corporate profits, have joined with restraint on spending to produce a unified budget surplus for the first time in nearly 3 decades. The important steps taken by the Congress and the administration to put federal finances on a sounder footing have added to national savings, relieving pressures on credit markets. Maintaining this disciplined budget stance would be most helpful in supporting a continuation of our current robust economic performance in the years ahead. The fact that economic performance has strengthened as inflation subsided should not have been surprising, given that risk premiums and economic disincentives to invest in productive capital diminish as the economy approaches price stability. But the extent to which strong growth and high labor force utilization have been joined with low inflation over an extended period is nevertheless exceptional. So far, at least, the adverse wage-price interactions that played so central a role in pressuring inflation higher in many past business expansions, eventually bringing those expansions to an end, have not played a significant role in the current expansion. For one thing, increases in hourly compensation have been slower to pick up than in most other recent expansions, although, to be sure, wages have started to accelerate in the past couple of years as the labor market has become progressively tighter. In the first few years of the expansion, the subdued rate of rise in hourly compensation seemed to be in part a reflection of greater concerns among workers about job security. We now seem to have moved beyond that phase of especially acute concern, though the flux of technology may still be leaving many workers with fears of job skill obsolescence and a willingness to trade wage gains for job security. A couple of years ago, almost at the same time that increases in total hourly compensation began trending up in nominal terms, evidence of a long-awaited pickup in the growth of labor productivity began to show through more strongly in the data. And this accelerated increase in output per hour has enabled firms to raise workers' real wages while holding the line on price increases. Signs of major technological improvements are all around us, and the benefits are evident not only in high-tech industries, but also in production processes that have long been part of our industrial economy. Those technological innovations and the rapidly declining cost of capital equipment that embodies them, in turn, seem to be a major factor behind the recent enlarged gains in productivity. Evidently, plant managers who were involved in planning capital investments anticipated that a significant increase in the real rates of return on facilities could be achieved by exploiting emerging new technologies. Notwithstanding a reasonably optimistic interpretation of the recent productivity numbers, it would not be prudent to assume that even strongly rising productivity by itself can ensure a non-inflationary future. Certainly, wage increases per se are not inflationary unless they exceed productivity growth, thereby creating pressures for inflationary price increases that can eventually undermine economic growth and employment. Because the level of productivity is tied to an important degree to the stock of capital, which turns over only gradually, increases in the trend growth of productivity probably also occur rather gradually. By contrast, the potential for abrupt acceleration of nominal hourly compensation is surely greater. As I have noted in previous appearances before Congress, economic growth at rates experienced on average over the past several years would eventually run into constraints as the reservoir of unemployed people available to work is drawn down. The annual increase in the working age population from 16 to 64 years of age, including immigrants, has been approximately 1% a year in recent years. Yet employment measured by the count of persons who are working rather than by the count of jobs has been rising 2% a year since 1995, despite the acceleration in the growth of output per hour. The gap between the growth in employment and that of the working age population will inevitably close. What is crucial to sustaining this unprecedented period of prosperity is that it close reasonably promptly, given already stretched labor resources, and that labor markets find a balance consistent with sustained growth marked by compensation gains in line with productivity advances. Whether these adjustments will occur without monetary policy action remains an open question. While the United States has been benefiting from a virtuous economic cycle, a number of other economies, unfortunately, have been spiraling in quite the opposite direction. The United States, Canada, and Western Europe have been enjoying solid economic growth with relatively low inflation and declining unemployment. But the economic performance in many developing and transition nations and Japan has been deteriorating. How quickly the latter erosion is arrested and reversed will be a key factor in shaping U.S. economic and financial trends in the period ahead. With all that is at stake, it would be difficult to overstate how crucial it is that the authorities in the relevant economies promptly implement effective policies to correct the structural problems underlying recent weaknesses and to promote sustainable economic growth before patterns of reinforcing contraction become difficult to contain. Responses in countries currently experiencing difficulties have varied considerably. Some have reacted quickly and in general terms appropriately. But in others, a variety of political considerations appear to have militated against prompt and effective action. As a consequence, the risks of further adverse developments in these economies remain substantial. And given the pervasive interconnections of virtually all economies and financial systems in the world today, the associated uncertainties for the United States and other developed economies remain substantial as well. In the current circumstances, we need to be aware that monetary policy tightening actions in the United States could have outsized effects on very sensitive financial markets in Asia, a development that could have substantial adverse repercussions on U.S. financial markets and, over time, our own economy. But while we must take account of such foreign interactions, we must be careful that our responses ultimately are consistent with a monetary policy aimed at optimal performance of the U.S. economy. Our objectives relate to domestic economic performance and price stability and maximum sustainable economic growth here at home, which would best serve the long-term interests of troubled financial markets and economies abroad. The Federal Open Market Committee believes that conditions for continued growth with low inflation are in place here in the United States. As I noted previously, an important issue for policy is how the imbalance of recent years between the demand for labor and the growth of the working-age population is resolved. In that regard, we see a slowing of aggregate demand as a necessary element in the mix. At this time, some of the key factors that have supported strong final demand by domestic purchasers remain favorable. With their incomes and wealth having been on a strong upward track, American consumers remain quite upbeat. For businesses, decreasing costs of and high rates of return on investment, as well as the scarcity of labor, could keep capital spending elevated. These factors suggest some risk that the labor market could get even tighter. And even if it does not, under prevailing tight labor markets, increasingly confident workers might place gradually escalating pressures on wages and costs, which would eventually feed through to prices. But a number of factors likely will serve to damp growth in aggregate demand, helping to foster a reasonably smooth transition to a more sustainable rate of growth and reasonable balance in labor markets.
Mr. Chairman, we are in the process of completing a vote. That's why our colleagues left. I just want to call this to your attention, and I'm down to 2.5 minutes, so I'm going to ask that we take a 5-minute recess so that our colleagues can come back so we can hear this testimony and then proceed with the hearing. So we'll take a recess for just 5 minutes.
Saw the chairman on the elevator as he's going to vote, and he said, go ahead and call it to order, and let's continue with the testimony. And with that, Mr. Chairman, you're recognized to finish your testimony.
Thank you, Senator. A number of factors likely will serve to damp growth in aggregate demand, helping to foster a reasonably smooth transition to a more sustainable rate of growth and reasonable balance in labor markets. We have yet to see the full effects of the crisis in East Asia on U.S. employment and income. Residential and business fixed investment already have reached such high levels that further gains approaching those experienced recently would imply very rapid growth of the stocks of housing and plant and equipment relative to income trends. Moreover, business investment will be damped if recent indications of a narrowing in domestic operating profit margins prompt a reassessment of the expected rates of return on investment in plant and equipment. Reduced prospects for the return to capital would not only affect investment directly, but also affect consumption if stock prices adjust to a less optimistic view of earnings prospects. Thus, members of the Board of Governors and the presidents of the Federal Reserve Banks anticipate a slowing in the rate of economic growth. The central tendency of their forecast is that real GDP will rise 3 to 3.25% over 1998 as a whole and 2 to 2.5% in 1999. With the rise in the demand for workers coming into line with that of the labor force, the unemployment rate is expected to change little from its current level, finishing next year in the neighborhood of 4.5 to 4.75%. Inflation performance will be affected by developments abroad as well as those here at home. The extent and pace of recovery of Asian economies currently experiencing a severe downturn will have important implications for prices of energy and other commodities, the strength of the dollar, and competitive conditions on world product markets. On a more fundamental level, it is the balance of supply and demand in labor and product markets in the United States that will have the greatest effect on inflation rates here. As I noted previously, wage and benefit costs have been remarkably subdued in the current expansion. Nonetheless, an accelerating trend in wages has been apparent for some time. In addition, a gradual upward tilt in benefit costs has become evident of late. Given that compensation costs are likely to accelerate at least a little further, productivity trends and profit margins will be key to determining price performance in the period ahead. We will be closely monitoring a variety of indicators to assess the degree to which productivity is on a stronger long-run track after what is likely to appear in the data as a weak second quarter. Monetary policymakers see the most likely outcome as modestly higher inflation rates in the next 1.5 years. The central tendency of monetary policymakers' CPI inflation forecast is for an increase of 1.75% to 2% during 1998 and 2 to 2.5% next year. As noted, the ebbing of the special factors reducing inflation over the past year or so, such as the decline in oil prices, will account for some of this uptick. But the Federal Open Market Committee will need to remain particularly alert to the possibility that more fundamental imbalances are increasing inflationary pressures. The committee would need to resist vigorously any tendency for an upward trend which could become embedded in the inflationary process. The committee recognizes that significant risks attend the outlook. One is that the impending constraint from domestic labor markets could bind more abruptly than it has to date, intensifying inflation pressures. The other is the potential for further adverse developments abroad, which could reduce the demand for U.S. goods and services more sharply than anticipated, and which would thereby ease pressures on labor markets. While we expect that the situation will develop relatively smoothly, the committee believes that given the current tightness in labor markets, the potential for accelerating inflation is probably greater than the risk of protracted excessive weakness in the economy. In any case, it will need to continue to observe evolving circumstances closely and adjust the stance of monetary policy as appropriate in order to help establish conditions consistent with progress towards the Federal Reserve's goals of price stability and maximum sustainable economic growth. As I have stated in previous testimony, the recent economic performance with its combination of strong growth and low inflation is as impressive as any I have witnessed in my near half-century of daily observation of the American economy. Although the reasons for this development are complex, our success can be attributed in part to sound economic policy. The Congress and the administration have successfully balanced the budget and indeed achieved a near-term surplus, a development that tends to boost national saving and investment. The Federal Reserve has pursued monetary conditions consistent with maximum sustainable long-term growth by seeking price stability. These policies have helped bring about a healthy macroeconomic environment for productivity-boosting investment and innovation, factors that have lifted living standards for most Americans. The task before us is to maintain disciplined economic policies and thereby contribute to maintaining and extending these gains in the years ahead. Thank you, Mr. Chairman. I'm available for questions.
Mr. Chairman, thank you for your testimony. And I have a few questions I'll ask, and then I'll yield to Senator Sarbanes from Maryland for his questions. There's some talk about what's happening in the Far East, and it seems to me that the Japanese economy certainly is important, and we need to kind of be aware of what's happening. If you were to be an advisor to the new Prime Minister, what kind of advice would you give him in order to strengthen the economy in Japan?
I think first, Senator, the issue is what's wrong with Japan. And I think there are a number of things which are wrong, but by far the most significant is the fact that following the bursting of the bubble in the early 1990s, which precipitated a very sharp decline in both real estate and equity values, essentially the collateral underlying borrowing in the system, a huge increase in non-performing loans was allowed to accelerate and fester in the banking system for a number of years, essentially unaddressed. This has created an erosion in the financial intermediary system, which has created significant slow growth for a number of years, and now under pressures of continuing erosion in the banking system, a weakness has occurred which has now tilted the Japanese economy downward. It's clear that they need to do two things. First is to address their banking situation expeditiously and in dramatic ways which perhaps would even go against the prevailing culture of the way things are done in Japan. And secondly, what they need to do, having done that, is to engage in more stimulative fiscal policy, specifically reducing taxes.
Thank you. Now I'd like to turn to our economy here and ask you a question in regard to the Congressional Budget Office, who once again dramatically increased their estimates of the budget surplus over the next several years. I don't like to refer to them as surpluses when we have this big debt still hanging over us, but at least we have revenues that are continuing to exceed expenditures. And what is the likelihood that this phenomena will materialize that they've predicted, and what are the greatest threats to it not materializing?
Well, I think that, Senator, is really the crucial question. As the experience of the last several years has indicated, the ability to forecast the trend of fiscal balances in the United States is not easy. And one of the reasons, of course, is we're dealing with very large receipts and outlays, small changes in either of which, especially in opposite directions, can move the budget deficit, the budget balance or surplus in a very dramatic manner. What has occurred in the last couple of years is a really quite remarkable acceleration in personal income tax receipts, which are not fully understood by analysts who have full data available to them. It's pretty clear that in 1996, the last basic annual set of data which we have in detail, that a substantial amount of the so-called income tax receipt surprises of last year were attributed to an underestimate of the extent of realized capital gains and the taxes that were paid on them. But there are also very substantial increased incomes which have been engendered by the rise in stock prices. We've seen a substantial increase in stock options, in bonus payments, and a number of related types of incomes, largely to upper income individuals who are paying very large taxes on them, and that has very markedly bolstered the receipt side of the budget. The key problem we have in projecting forward is how much of that to presume will continue, and how one answers that question can very dramatically alter the outlook. The most general forecasts which are being made largely by OMB and CBO, for example, tend to assume that a goodly part of, one, the increased rates on a number of these different personal taxes will increase, and that productivity acceleration, which seems to have been in the works, will continue into that period. If that occurs, and there are no other policy actions, obviously the surpluses will occur, and I think it's important to recognize a major force in the forecast is once you start on what is clearly a virtuous cycle of surpluses, you bring down the level of debt, which brings down the interest costs of that debt, which makes the surplus even larger, which makes the debt even lower, and you get a fairly dramatic reduction in aggregate debt, which has some very important and very positive consequences. But to answer the bottom line of your question, I think you have to realize that a number of these projections are very tentative and indeed can reverse as dramatically as the estimates made 2 or 3 years ago have been reversed.
Thank you. I'll now yield to the senator from Maryland for some questions.
Thank you very much, Senator Allard. First of all, Chairman D'Amato and I received a statement from the AFL-CIO to be entered in the record, and if that's not yet been done, I'd like to do that at this point, Mr. Chairman.
Without objection.
And I just note in that statement that they say it is good news for American workers that the nation's unemployment rate is edging closer to our historic full employment targets that at any other time since the Humphrey-Hawkins legislation was adopted in 1978, which of course would fit in with your observation, Mr. Chairman, at the end of your statement about this being the, I forget exactly how you put it, the strongest economy that you've seen in, was it 50 years, I think you said?
Near 50 years of watching the economy daily.
Yeah.
It's really quite a remarkable exhibition by complex economies such as ours.
I just want to make this observation. I remember at the time Humphrey-Hawkins was passed, and thereafter everyone said, well, it's absolutely ridiculous. How can you have a 4% unemployment rate, and yet we're now down to a 4.5% and still no significant inflation. So that goal seems a lot more realistic and credible than it did in the past as people criticized it. Mr. Chairman, I'd like to ask you first about the IMF funding. It's asserted by some that the IMF has enough resources that they don't need a general quota reserve, and the observation is made that they have about $45 billion. But my understanding is that 30 to 35 billion of that 45 billion has to be set aside by the IMF in order for it to be in a position to meet the right of member countries to make demand withdrawals of their reserve deposits, so that the figure looks larger than it really is. That in fact the IMF has only 10 to 15 billion of usable resources in its general quota reserve, and in fact reflected this squeeze in that the Russian package took only $2.8 billion out of the general quota reserve, and the balance came out of the general arrangements to borrow, which means the IMF now has only $7 to $12 billion of its own effectively loanable quota reserves. First of all, is this analysis correct in your estimation in terms of what's available to the IMF, which seems to me to be a disturbingly low amount? My understanding is the lowest amount that they've ever had on hand. And if the analysis is correct, what does that say in terms of the urgency for Congress to act on the IMF quota increase?
Those numbers, Senator, are very close to the ones that we use. And I would certainly agree with you that they're down to rock bottom, and that while I have considerable sympathy for a number of the arguments about how we ought to change some of our international financial institutions, that's an issue that should be put aside while we confront a crisis which continues to mount. And in my judgment, approving the quota is crucial to put the IMF in a position to address potential other crises which may arise in the short term. I think after that, after this particular period of disruption is passed, I think it would be perfectly appropriate to go back and re-look at the way the whole structure of financial institutions are positioned, largely because we are in a different type of global financial system, in the sense that really since the beginning of this decade, the alterations in the types of markets that have evolved and the types of products that have been constructed has given us a new, very dynamic, productive, but in certain sense somewhat worrying set of relationships. In other words, money moves at paces which are really far quicker than anything we had seen before, and we have to address our system and our structure in that context, so that at that point, I think we would be well served to look at the IMF, its structure, and see whether it serves the purposes of the new global financial system, but not at this point.
Now, part of the total picture is not only the money the IMF has available to meet crises, but the likelihood that crises will occur, or how fragile the current international situation is. I'm struck by the fact that this statement from the AFL-CIO, which I mentioned earlier, is almost entirely devoted to the East Asian crisis, the financial crisis, and the impact of that potentially on the U.S. economy. I'm a little hard put to understand why what's going on in Asia, and now of course we've had as it were, an extension to Russia. Who knows who's next? Seems to be being discounted to the extent it is in the workings of our own markets and in economic thinking in this country. It's as though these very serious developments are taking place, and any analyst then says, well, the potential consequences of these are very far-reaching, and yet everyone seems to be going, not everyone, but most people seem to be going blissfully along as though there's little danger that it will have any impact on us. Do you have any observations as to why that seems to be the case? I know you've been sounding the warning bells, and Secretary Rubin and others, but why do people seem not to be hearing these warning bells?
Well, it's obviously difficult for me to judge, but I will comment on the fact that the initial impact of the Asian crisis is in certain sense been to stabilize some of the hot spots in the American economy, and indeed probably have contributed to stronger growth here and lower inflation and greater stability than would otherwise have been the case. So it appears that the initial response of the Asian crisis has been positive, not adverse. The major concern that I have is that that obviously cannot continue indefinitely. At some point, it ceases to be other than adverse, and while the probability that it will markedly impact the United States is, as I've said in the past, quite small, the consequences of that occurring, even though the probability is small, the impact would be of such a nature that we should not be taking the risk, even with a relatively small probability of an adverse event.
Thank you, and now I'll yield to the Senate, or Chairman, who's back from voting, and I think he has a few questions for you, Mr. Greenspan.
Thank you very much, Senator. Mr. Chairman, let me touch on something tangentially that Senator Sarbanes touched on, and that is the question of Japan and just how serious that problem, how acute it may be, particularly as it relates to their banks. We get all kinds of estimates. I heard, you know, they're just incredible. Some say 27 times the size of the problem that we had. I mean, is there sufficient transparency or data to get a legitimate estimate as to the true size of the problem as it relates to their banks?
The Japanese authorities, I think, are increasingly becoming aware of the issue of the need to become far more transparent than they have, and they're moving in that direction. The problem, however, is that with the real estate market still essentially moribund, and the degree of the volume of transactions that are going on still quite small, it's very difficult to get values on real estate, which is the major collateral underlying a lot of those loans. So the ability to judge how poor a particular loan portfolio is actually even difficult for the banks themselves, because they do not really fully sense what is the underlying value of what they got. One of the issues that we have argued strenuously with our Japanese colleagues is to try to sell properties into the real estate markets, which are currently now in the hands of the Japanese government, to do effectively what we did with the RTC, that is, regalvanize the real estate market so that you get real prices, you get real markets, and you can make far better judgments about the underlying collateral of loans, which is a necessary condition to making a judgment of how bad they are. The numbers that the Japanese authorities are publishing are very large, and the size of the problem is unquestionably substantial, and one need only look at the vast amounts of public funds, taxpayer funds, which they're bringing to bear to endeavor to resolve this issue. The difficulty is large, and I think that's the reason why, as I said earlier, allowing the problem to fester as long as it has been allowed to fester has been a major mistake, which is going to make it, and has made it, far more difficult to resolve than it would have been, say, 5 or 6 years ago.
Let's come closer to home as it relates to the concern that I think you and others have expressed with respect to the possibility that credit underwriting standards at our own institutions may be less stringent than advisable. To what level of concern is that to you and to the Fed?
Well, Mr. Chairman, I think what our experience over the years clearly demonstrates is that it is in a period such as now that bad loans are made. That
You mean when things are booming?
when things, you do not have very much risk of creating a poor loan portfolio at the bottom of the business cycle. Nobody makes bad loans. They don't make any loans, but they surely don't make bad ones. It's now when the loans that are which will ultimately run into trouble are being extended in a competitive race, one bank against the other, to lower their cost of fund, to lower their loan rates and yield spreads. What we know is, with almost no data, that the loans being made today will have a non-performing ratio to total loans much higher than currently exists. We don't know how much, but we do know that if history is any guide, that now is the time to be circumspect. And on the basis of certain studies we have done, we have concluded that there has been less circumspection than seems to be appropriate for this time period. And some of my colleagues have raised the issue both at the staff level and at the governor's level. And I think to state that we find the issue somewhat discomforting is to underemphasize the potential problems that may emerge.
Let me then follow up just with one more as it relates to that. What specifically are your examiners doing in relationship to this? Are we trying to get ahead of this problem, recognizing the difficulties we've experienced in the past?
Well, what we do, and obviously we can't induce people to be other than foolish in certain loan practices, we can nonetheless bring to bear and try to indicate to loan officers and to the senior management of the banks that in our judgment, on the basis of our experience and our evaluation, that practices have become somewhat looser than they should be. I don't want to say, because it's not true, that we have evidence at this particular point that there is a mounting degree of loan losses. On the contrary, if you look at the data, it is really quite remarkable how few losses there are and how few of the loans are in delayed payment. In fact, it's that very process which is creating some letdown of people's guard, and it's precisely that concern which we're trying to effectively arouse concern about.
Well, I applaud your efforts in that area because we have experienced the other problems in the past, and so we urge you, I particularly commend you for calling this publicly to our attention and to those in the banking industry. They've got to be vigilant. As you've indicated, it's something that's so obvious, but we tend not to think about it. At the time that you make these loans is when you've got this great prosperity, not when you have a tightening of credit. So thank you very much, Mr. Chairman. Thank you.
I now recognize Senator Kerry.
Thank you very much, Mr. Chairman. Mr. Chairman Greenspan, welcome. This is a remarkable document. You've stated in your last paragraph and reemphasized the degree to which this represents an extraordinary sort of set of perceptions on your part in the years you've been watching. But as I read through the document, I was struck by that paragraph for paragraph, each place where there was sort of some sense of a cloud or potential transition, you seem to have an economic countervailing force that was addressing it, and the market obviously is doing both what it's supposed to do and an extraordinary job. But I wanted to ask you a couple of questions about the virtuous cycle that you described and a couple of the notes that you've made about the future. You particularly pointed to the working age population increase growing at about 1% a year, but the 2% a year rise in the number of people working, which is really quite fascinating, and that comes about obviously because the productivity increases, I gather, principally.
No, actually, we are, because the number of people going into jobs is rising at 2% a year, and the working age population, including immigration, is only 1%, we are getting those additional people from, one, reduced unemployment officially, and two, from a significant number of people who are not in the labor force, because they're not actively seeking jobs, who would nonetheless like to work. The combination of both of those types, those groups of people who want jobs but don't have them, has been going down gradually, year by year, and in a sense we're dipping into a reservoir which ultimately is going to be probably at a minimal level unless we close the gap between increased working age population and the number of increasing, the rate of increase in the number of people working.
That's precisely what I wanted to get to, because you said, you say still the gap between growth in employment and that of working age population will inevitably close. What is crucial to sustaining this unprecedented period of prosperity is that it close reasonably promptly, given the already stretched labor resources. Could you share with us sort of what trend line you view as essential with respect to that? I mean, how reasonably promptly must you expect that to close in order to sustain this? And what are the dangers that you see in terms of that gap and not closing?
Yeah, that's a good question, Senator, because it's not easy to answer. The reason I say that is that clearly the sooner it can be closed, the better, because that will immediately relieve the increasing pressure on labor force, or rather on labor resources, although it is still very taut at this particular time. If we continue for certainly another year under these pressures, the risks go up. But I cannot say to you, because we still do have, I think the number is approximately 10 million people who are in these two groups. The ratio to the population is close to is at the lowest level in the series that goes back to 1970.
Do you have a breakdown on the nature of that group? To what degree there are people within that group that are in fact employable versus conceivably chronically unemployable?
Yes, those data are published by, they're published by the Bureau of Labor Statistics, and if I can shuffle through these papers in 2 seconds, I hopefully will.
But that breakdown, I assume you would agree, could considerably affect the rate at which that gap can close.
Certainly.
And I would assume also might affect what we might need to do with respect to helping to keep it moving, no? I.e. transitional training or even entry-level training.
Yeah, absolutely. I think that one of the characteristics that we have seen in this particular recovery is that because of the tightness of the labor markets, the value of on-the-job training and the remarkable expansion in community colleges, which have been giving courses to people trying to upgrade their skills, is something which has really had a major positive effect on our workforce, and probably would not have occurred to the extent that it has if we didn't have the tightness in the labor market that we would want. Incidentally, the number of the two elements that we use for the population aged 16 to 64, as of June, total unemployment was 6.1, and those not in the labor force but who nonetheless want a job of 4.5 million. So we're somewhat over 10 million, and that number has been progressively falling for the last several years.
Mm-hmm. I see the lights on. I'd like to come back if I could then.
How many more questions do
Just
you
a
have?
couple of more.
Well, why don't you go ahead and, if it's all right with the rest of the committee, go ahead
Is that
and
all right?
finish your two questions. And in the meantime, I'm going to turn the chair over to Senator Grams from
Thank you
Montana.
very much.
Or Minnesota. Minnesota.
Mr. Chairman, my other question, and I appreciate your answers on that, is you described the virtuous cycle, and I think I understand it in the context of the accelerated productivity raising the expectations of the future corporate earnings that you described, and then that fueling further increases in the equity values, and then ultimately the improvements in productivity reduce inflation. Now, if you go around in that, the question is there a reality check in the expectations that you refer to as central to what is fueling this? Is there a point where the values may be exceeding a reality where you may have a kind of artificial bubble that somehow is riding the tiger, so to speak, the back of the tiger? Do you sense that at all?
Senator, there are two ways of responding to that question. First is, as I indicated in my prepared remarks, a significant part of the rise in equity prices has resulted from a continuous increase in long-term expected earnings, starting from evaluations of security analysts in early 1995, virtually continuously since. In other words, they have raised their long-term expectations virtually month after month, and the current level, which is well over 13% annual rate, if projected indefinitely in the future, projects a very marked rise in profit margins and the share of profits in the national income. History tells us that that is going to run into some difficulty sooner rather than later, which suggests that these 3 to 5 year projections of analysts are unrealistic, and that the real world will somehow converge and suggest that to them in no uncertain terms. Failing that, there is an ultimate element which you cannot go beyond, which essentially is the extent to which human beings discount the future, in the sense that part of the evaluation, stock market values can essentially be broken down into expected long-term earnings and the discount factor one applies to that to get a present value, which is effectively the stock price. That number has been falling quite consistently, which is essentially a combination of long-term interest rates plus what we call the equity premium. That can go down just so far. At some point, we are discounting the hereafter, and the markets at that point fail to move further. Which happens first, I do not know.
Well, that'll be interesting to find out. I hope we're not there when we do. The final question I want to ask you is, you also point to the special relationship in the labor market itself, the pressure on wage price increase and the productivity input that has reduced some of that pressure, as well as the good behavior of the consumer price component. My question is there a sort of sooner rather than later confrontation with that component of the good behavior on both sides, because there's sort of been a wearing out, if you will, of this experience of older and sort of more traditional manufacturing and service-oriented industry workers sort of having used up their fear of the transition into the information market age, and a huge provision or influx of the younger, more skilled, and much more expectant, demanding workers, and there's sort of a clash then of the two, that you've lost the goodwill of people being willing to take wage benefit cuts in order to simply have a job. And is that a potential kind of
That's an interesting
fly in the ointment?
Yeah, that's an interesting view, Senator. I mean, there's unquestionably something in what you're saying. The only issue is how long it takes before that process occurs. We do observe that the job skill obsolescence to which I refer in my prepared remarks tends to be far more prominent amongst older segments in the workforce, people who have not been brought up with a word processor or a complex computer or the technologies which seem so obvious and sensible to somebody coming out of college today. It's being assuaged, however, in part by this fairly dramatic back-to-school attitudes of numbers of workers. One of the most fascinating statistics that we've seen in the last several years is that the average age of people who are full-time undergraduates in college has gone up 3 or 4 years. And it suggests that the fear of this new technological world, which is inducing this shift towards job security relative to wage gains, is also creating a major impetus to go back to school. And indeed, that's where the big expansion in, on the one hand, on-the-job training, for which the workers are really pressing, and two, community colleges and other institutes which endeavor to increase skills is coming from. So for the moment, that crunch that you raise is partly being met by this shift in educational processes and educational markets, which has presumably markedly increased the skills of many, many people in our labor force, and maybe forestalled this confrontation that you raise for a while. But the truth of the matter is, I don't know how we would know for sure when that was arising.
I thank you very much, Mr. Chairman. Thank you for your courtesy, Mr. Chairman.
Thank you. Mr. Greenspan, welcome.
Sir?
I have just a couple of quick questions, and I see we've been joined also by Senator Dodd, but I don't want to be the pessimist, but I want to look beyond this bubble of good economic news a little bit. And, you know, clearly I think our short-term economic and fiscal outlook has improved in the recent years due to what you called the delicate equilibrium, I believe, that has allowed the U.S. to enjoy fast economic growth, high employment, and low inflation. Now, the Congressional Budget Office recent estimate shows that we may have as much as a $1.5 trillion unified budget surplus and nearly $170 billion on-budget surplus over the next decade, and I think you should share in a lot of that credit because of your very prudent monetary policy. But, however, many long-term imbalances are still hanging over our heads, and without addressing these future risks, I think steady growth is impossible. A major risk, I believe, is the imbalance between the government's entitlement promises and the funds it will have available to pay for them, specifically Social Security. Now, Chairman Greenspan, if we don't fix our Social Security problems, such as the unfunded liabilities, and I don't know if we have a handle on those numbers, how much unfunded liability is out there, what will be the consequence?
It's about $9 trillion.
How much?
$9 trillion.
Of unfunded liability for Social Security. With that in mind, what will the consequences be for our economy and our long-term monetary policy, our interest rates, inflation, et cetera?
Yeah. Senator, I think that one thing that's come out of a lot of these long-term projections of the budget is that over the very long run, given the types of commitments, as you put it, for entitlement programs, that it's very difficult to close the gap between the long-term commitments and long-term revenues. And what is crucial in this regard is to make sure that when we think in terms of retirement programs, that we set aside the issue of what finance and these types of projections are showing us, and remember that there's a very fundamental question which is involved here, namely that when you have a significant increase in significant increase in the proportion of your population which is retired, it means that you're going to have to create a much larger volume of goods to sustain both the working age population and the retired population in the future, but produced by the working age population by definition, which is another way of saying you need a significant increase in productivity. And one of the aspects of running these very large unified budget surpluses is that it tends to create a fairly marked decline in the federal budget debt, in long-term interest rates, and a fairly important increase in national savings, which will ultimately feed into capital investment and the higher productivity which is required to sustain the retired population at anywhere near the real wage that those people had at their point of retirement. As a consequence of this, I think that we should not be mesmerized into these very major, mega-sized apparent surpluses, because if we take out of them, as you put it, some amortized estimate of the unfunded liability for all of our entitlement programs, that surplus disappears. Mm-hmm. And while I've argued in the past, and I would argue today, that from the point of view of the budget that we would look at to analyze its direct, immediate impact on the economy, the unified budget balance is the appropriate number. But to look at the commitments in the future as to whether the intergenerational transfers are appropriately being funded, then we have to look at something which excludes at least the Social Security budget to get a sense of what the longer-term outlook is. So I do think in the debate which is inevitably going to occur as a consequence of these new numbers, and it's, I must say, it's the type of problem that is nice to have compared to what we were dealing with 10 years ago, I think we ought to recognize that, one, as I indicated earlier, we have to be a little careful about the certainty we may have about whether these surpluses will arise at the levels which are being projected, but even if they do, what it is we wish to do with them. I would say that reducing the debt is a very high priority that we should look towards as a major component of what we do with these surpluses. I think we ought to be very cautious about new entitlement programs which, once they're in place, will eat up revenues at the pace that we've seen in the past, and it becomes very difficult to reverse. To the extent that people make judgments that it's very difficult to sit there with huge surplus in the unified account and that it will be spent if we don't do something with it, then I would say the second most important thing is to give it back to the taxpayer. Mm-hmm. But it's the type of problem, I must say, which is a pleasant type of problem to be confronted with.
But watch the spending levels.
I'm sorry?
Watch the spending levels.
The one thing that can go wrong in this whole process is that we think we've got a big bundle of cash, we commit it to the future, and find out that most of it isn't there.
I have another question, but I'll go to Senator Dodd.
Thank you very much, and I appreciate, Chairman Greenspan, your presence here today, and congratulations again on a tremendous job I think you and the Fed are doing for our country. Just on the last question that the Chairman has raised, as I hear you, your concern here is be careful of the deficit.
Yes.
And that's really the underlying issue here. I mean, it's a question of whether we have revenues, what we do with them, whether we spend them or we take them off the table through tax expenditures. The point is we ought to be careful about assuming a surplus that we have today is going to be there now for any length of time. And so it's the fiscal responsibility that's underlying.
Yes, sir.
Let me, if I can, and by the way, if someone has raised this, Mr. Chairman, other questions, please interrupt me. And there's no point having the Chairman repeat answers to questions that may have been raised by others, and I apologize having to step out. We had a hearing up in the Labor Committee I wanted to attend briefly. I know you've spent some time, I gather, talking about Japan, and obviously that is important. I wonder if you might share with us some thoughts about China. We're talking about how Japan's difficulties and the Asian problem generally are affecting us. I wonder if you might share with us, to the extent you feel that it's worthwhile, to comment on how the Asian economy is affecting China, and to what extent, if China is at all at risk in this, does that place us in any longer-term risk? I think it's been said, I hope it has been here, again, how much we appreciate, I think, the fact that the Chinese have not devalued the currency and how important that has been to us. But I was stunned by some of these trade numbers where we actually had exports were down 1.2% or 2.2% this first quarter. They were actually, the last quarter, up 8.3%. Imports were up 17.1%, whereas they had been 5.3% in the last quarter. But I wonder if you might just comment.
Are these, you citing the Chinese numbers at the moment, or ours?
No, ours.
Yep.
Yeah.
I mean, and our bilateral with China.
No, these were global.
Oh, you're talking about our global numbers.
Yeah. Okay. But I go back to my question about China specifically.
Senator, as you know, the Chinese economy's growth rate is slowing down. The official objective that they perceive to be necessary to maintain economic reform and stable labor markets is a growth rate of about 8% per year. The growth rate has slipped so far. It is, according to their official figures just recently released, was 6.8% annual rate in the second quarter. And there are those who believe that the pressures from the economies contiguous to China are clearly creating problems. Obviously, their exports to a number of the so-called, we used to call them tigers, I don't know what we would call them at this particular stage, is down quite appreciably, as it is to Japan. It has created internal financial problems amongst the state-owned enterprises where their earnings and cash flows have been under severe pressure. It's clearly been the case that as a consequence of the weakening Asian situation and its impact on China, that the full thrust of the reforms that have been underway are in some jeopardy, and that when you are confronting a short-term crisis, you tend to push longer-term things somewhat aside. Wow. Nonetheless, there's no doubt that they see the great advantages of moving increasingly towards a market economy and the benefits that they have clearly perceived as a consequence, so that there's no evidence of which I'm aware would suggest that they're in any way backing away from the longer-term thrust of their policies, but the current situation is giving them some concern, and I think rightfully so, but when you sit right in the middle of a East Asian economy that is undergoing fairly significant contraction, that it would have little or no effect on China is obviously most unrealistic.
Yeah. You know, we speak, of course, of the impact of what's going on in Japan on our economy. We read about the difficulty with the IMF issues regarding Russia, and I think most people think about it as sort of an IMF-Russia issue. I'm not sure they think about it in broader terms, but as Japan is to the United States, I suppose Russia is to Europe. And given the European exposure in Russia, to what extent does the Russian economic condition pose any longer-term problems vis-a-vis the European economy? And again, to what extent does that pose some longer-term risk for us?
Yeah, I remember that the Russian economy is far smaller than the Japanese economy, and that is an element of importance. The actual ties of Europe directly to Russia through the trade accounts is not all that large. There's not a great deal of trade. Indeed, one of the fascinating characteristics of the demise of the Soviet Union is the extent to which all of those inter-Soviet bloc states' trade virtually evaporated. Nonetheless, there are significant financial ties. I mean, the German banks, for example, have fairly substantial commitments, as indeed the German government, through the banks, is also. So that difficulties in Russia do spread through the financial system and to a limited extent through the product markets. But that can have a negative impact on Europe, and indeed I think it's given concern to a number of European analysts for exactly that reason.
I see the clock is on, Mr. Chairman. I thank you. I have another question or two, but I'll...
Why don't you go ahead?
Well, thank you very, very much. And again, if these issues have been raised, Chairman Greenspan, please just say so, and I'll go back. I gather you had, there was some, you commented on the underwriting standards used by banks, and I gather that issue has been addressed. I was intrigued about the numbers affecting consumer, personal consumption, how the numbers were up, and that I guess a lot of that is attributed to the increase in real disposable income in the first quarter. I wonder, we're going to be asked to vote here fairly soon on a, and I'm not asking you to comment on a bill, but just on the general concept here. We're on bankruptcy reform issues. And I think all of us are kind of inclined to want to do something about it. There's been a tremendous increase. I notice in just my state alone, I think the last 3 or 4 years went from 8,000 to about 13,000 bankruptcies in Connecticut. The article in the paper the other day. But I also note that last year alone, the banks issued, or at least solicited, sent out some 3 billion solicitations for credit cards. And and a lot of them are, of course, pre-approved. It's a very competitive market, and it's a very lucrative one. I'm worried about this rise in consumer debt, and to what extent are we looking at personal consumption maybe that is related to consumer obligations, and are we in some danger here without getting into a bill? I don't want to ask you to comment on the bill. But to what extent ought we to be looking at the issue of this explosion in plastic as a potential threat to longer economic stability?
I think we're acutely aware of it because it's plastic, as you put it, is everywhere, except as a big number in our financial statistics. Actually, credit card debt, while growing fairly substantially, is still a relatively small component in our economic system. I mean, mortgage debt, household mortgage debt, is huge compared to that debt. And there's no doubt that there's been a fairly dramatic endeavor on the part of banks and finance companies and other institutions actually, to cater to this market because it's growing at a fairly good clip. And despite the fact that there are substantial losses by the very nature of the type of instrument, the interest rates which are charged more than captures the losses and creates a reasonably good rate of return. So it's turned out to be good for both consumers and for financial institutions. It is certainly the case that credit card delinquencies are much higher than certainly, say, mortgage delinquencies by a huge order of magnitude. But actually, they've come down in the last 6 months. That is the delinquency rate. And as I'm sure you're aware, the bankruptcy rate for other than businesses it's pretty much flattened out in the last number of months. So we're not getting evidences that we see that the situation is deteriorating. And there is an interrelationship between credit cards and this process. It's something which I think should be addressed. I think that the fact that we've had this huge increase in bankruptcies in a period of really quite remarkable economic expansion and falling unemployment rates tells you that something is probably something needs some form of adjustment.
Yeah.
What that is, I don't feel sufficiently expert at, but I will tell you it sticks out like a sore thumb out of the other economic statistics.
That's the reason I raised it. Lastly, and again, you raised this with, I think in response to some of Senator Kerry's questions I came in, but again, this unprecedented economy across the country, but I think in inner cities and rural areas, some rural areas, of course, they've been untouched by a lot of it, as we see, and particularly some of the farm state issues that have been raised. I get concerned about this education gap. I've heard you talk about this and heard you address it briefly here today, but I have this great concern, even though people going back into school and ongoing education, I worry in certain sectors of our economy that that's not happening at all, and that I see this gap getting wider and wider each year. Nesbitt wrote his book on megatrends a number of years ago. He picked 4 states to look at, California and Florida for obvious reasons a number of years ago, the demographic changes, and Colorado and Connecticut. And in Connecticut, you're looking at a relatively small piece of geography about the size of San Diego County, where you have tremendous affluence. I mean, obviously the highest per capita earnings in the country. And yet my inner cities of Hartford, New Haven, and Bridgeport, for instance, rank in the top 30 of the poorest cities in America. So in a space of 110 miles by 50 miles, you have incredible affluence and you've got some real poverty. Now, we don't have much of a rural area in our state. But you don't, and you're getting, seems to be, while we have a strong middle class still, and the economy's improved tremendously over the last number of years, I go from schools in my suburban communities and see what's going on. And I go to schools in my urban areas, and don't want you to get involved in the discussion of an education discussion per se, but I see just tremendous disparities in terms of the opportunities. Not on the level of intelligence and the desires and so forth, but there's a huge gap educationally that's occurring. And I don't know if you have any thoughts on this particular concern, beyond the question of technology moving people into an ongoing education experience, which I think is probably true. But I'm more concerned about something more endemic here at another level.
Well, just let me to reinforce your concerns. The evidence that the gap of the relationship between the degree of education and income is increasingly been reinforced in the last decade or two. In other words, as the premium of having a college education over a high school diploma has continued to increase, and the premium of a high school diploma over a dropout has continued to increase. You can see it in the labor market. You can see the whole process of the skill differentials becoming ever more pronounced. And since our economy is at the cutting edge of technology where ideas matter, the proportion of the gross domestic product which is comprised of conceptual as distinct from physical is consistently increasing, which is going to make this problem even worse unless we can find a means to bring up those in the lower echelons of the society to educational levels which brings them into the mainstream. I think we have found in today's environment that a number of people who themselves thought of themselves as not having the capacity to do the types of jobs which really pay well have been proved wrong when they've been pressed, when they have been given on-the-job training, when they have been, in a sense, prodded in some cases to reach out for things that they didn't think they could do. They have, for the most part, found they could do it. Yeah. And so it's really an issue here of how does one create incentives to encourage people to reach out, because that's going to be the way in which we're going to solve a lot of these problems. And if we can find means to encourage them, improve the environment in a manner which they feel encouraged to do it, I think that we'll find that that's where the solution lies. It's not in trying to get new types of schools with heavy equipment in it, because that in itself isn't going to do it.
Thank you, Mr. Chairman. I am very grateful to you for allowing me to do that. Thank you.
Thank you, Senator. Mr. Greenspan, I appreciate your time, and I don't want to keep you very long, but when one feels the power of the gavel, he doesn't want to let it go real quick. But I just had a couple of quick questions, and we talked a little bit about Social Security unfunded liabilities. As you're well aware, there's going to be a great debate going on, if it's already started, but over the next couple of months at least, on how to reform our Social Security system. Where do we go from here to make it solvent? One approach would be to let the government invest part of the Social Security Trust Fund surplus into the financial market. Would you believe this is the right direction to go?
No. I think it's very dangerous. I think that the presumption that you can somehow have, and I assume this is what you're suggesting, that the Social Security Administration invest in equities. I don't know of any way you can essentially insulate government decision makers from having access to what will amount to very large investments in American private industry. There are undoubtedly many presidents, many members of the Congress who would look at the thought of employing that type of leverage which the government would have as anathema. There are others who would not. And I'm fearful that we are taking on a position here, at least in just conjecture, that has very far-reaching potential dangers for a free American economy and a free American society. And it is a wholly different phenomenon of having private investment in pension funds in the market where individuals own the stock, vote the claims on management, and having government. I know there are those who have views that beliefs that it can be insulated from the political process, and they go a long way to try to do that. I've been around long enough to realize that that's just not credible, not possible. Somewhere along the line, that breach will be broken, and I think it will be much to the detriment of the American society.
So just to be clear, you're not opposed to personal retirement accounts being established and allow the individuals to invest in the market, but alongside of having the government control those accounts and have the government do the investing.
That's exactly. Even if you're in indexed funds, it's a slippery slope away from that. But I'm strongly supportive of going to private funding where individuals control the claims on the corporations. I just feel it is a slippery slope of extraordinary magnitude to move that power into a government agency.
And just finally, Mr. Greenspan, what if Congress, instead of trying to maybe move to more of a personalized retirement accounts, but what if Congress would decide just to look at the old system, tinker around the edges, and maybe raise payroll taxes to fix the Social Security problem now instead of pursuing real reform? Would these taxes resolve the problems of Social Security in the long run? And how would that tax, again, affect national savings, investment, interest rates, et cetera?
Senator, I think you have to look at it in two ways. You have to look at it in terms of whether or not you're creating a pay-as-you-go Social Security system or whether you're fully funding it. And one of the reasons I might add, as I've indicated many times before the Congress, why I'm inclined towards private accounts is I think it far more readily will move towards full funding, which I think is essential, as I indicated earlier, to create the savings which will create the investment and the production of the real goods that are required for retirees. I think that what is involved here is essentially to recognize that you can, if you want to, create a pay-as-you-go system, and it will work for the 75-year horizon which they always create by jiggling with the tax side and the benefit side. And that will keep the system going in the way it's been going. The question, however, is that with the significant demographic changes about to be created in the United States, where the population is aging, the proportion retiring is increasing year by year, that we can afford not to have far more funding. It may not even have to be full funding, but clearly the more funding you have, the greater the capacity you have to employ current savings for investment into assets, productive equipment, which produce the real goods that are required to finance retirees. A pay-as-you-go system does not do that. It's a mere intergenerational transfer or transfer from workers to retirees, and in and of itself does not provide the increased productivity which a full funding system would engender.
I think to keep the current system afloat, if I'm not mistaken, in the last several decades, Congress has had to tinker 51 times with either raising the Social Security tax, adjusting the income on which it's levied, or tinkered with the benefits. And that's got us into the problem we are today. Would you see it would have to be even higher taxes, less benefits, and greater income levied against in order to maintain even the present pay-as-you-go?
Well, the current Social Security Administration projections indicates a gap which would have to be closed either on the revenue side or on the benefit side.
Mr. Chairman, I want to thank you for your time and your patience. I appreciate your being before this committee. Thank you very much. The hearing is complete. Thank you.
Thank you, sir.
No, there's some questions I want to